March 2023, Silicon Valley Bank collapses. A stablecoin that's meant to be worth $1 briefly isn't. And over the next 3 days, according to Europe's own markets regulator, the value bots pulled out of Ethereum jumped 8,000% above that month's baseline. 8,000. Not from trading, from standing in front of other people's trades. So a viewer here, Joshua, asked me something I couldn't put down. He said Hedera is supposedly mathematically immune to this. Is that true? And if it is, why isn't it doing anything for the token? So I read the regulator's report, the original paper, Hedera's blog, and then Hedera's developer documentation. And that's where this got interesting, because Hedera's engineers and Hedera's marketing do not use the same word. So what is Hedera claiming to be immune to? I'll use somebody else's words. This is the European Securities and Markets Authority, the EU's markets regulator, not a crypto company. July 2025. In traditional finance, they say, central authorities enforce a fixed order, first come, first served. You queue, and the queue is the queue. But on most blockchains, quoting them, there is no pipeline creating a single queue. Your transaction just sits somewhere public while it waits. And the regulator calls that place a waiting room. That's their word, not mine. The technical name is the Mempool, and that room has glass walls. When you hit swap, your trade doesn't execute instantly. It stands somewhere anyone can read it. What you're buying, how much slippage you'll put up with, visible, before it happens. So you announced your trade to the whole world, and then you made it. Somebody did write the paper. 2019, Philip Dian and a team at Cornell published Flash Boys 2.0, and it landed at one of the top security conferences in the world the year after. They named the bidding war over who goes first, a priority gas auction, and they named the whole phenomenon, miner extractable value, MEV. And a year later, in 2020, a Paradigm essay gave it the name that stuck. Ethereum is a dark forest. Quick correction while we're here, because almost everyone gets this wrong, including a lot of videos you've seen. That essay was written by Dan Robinson and Georgios Konstantopoulos. It's routinely credited to Samson. He wrote the follow-up called Escaping the Dark Forest, after helping on the rescue attempt in the original. Small thing, but if we're going to spend a video being precise about who said what, let's start with that. Oh, and one more from the regulator, not the crypto crowd. ESMA points out people were already discussing miners abusing their position as early as 2013, 6 years before the famous paper. So Flash Boys 2.0 didn't discover MEV, it proved it and gave it a name. So what do they actually do to you? Only a few moves. Front running is a bot seeing your trade in the waiting room, paying more to go first, and taking the price you were going to get. Back running is sliding in behind you to clean up what your trade left on the table. And then there's the one that costs regular people money, the sandwich. Here's how it feels. You go to buy a token. A bot sees you coming, buys first, which nudges the price up. Your buy fills at that worst price, and the bot sells straight into the bump you just made. It bought before you, sold after you, and you paid for both halves. And you'll never see it. No line item, no fee on your statement called bot. It just looks like a slightly worse fill, so you shrug, blame slippage, and move on. A tax with no receipt. And I want to make that real because it isn't a thought experiment. March 12th, 2025. Somebody swapped about $220,000 of USDC on Uniswap. Stablecoin to stablecoin. About the most boring trade there is. They got back $5,200, roughly $215,000 gone in about 8 seconds. And that same trader got sandwiched 6 times that day, around $714,000 total. But here's the detail I can't stop thinking about. Of that 215,000, the bot kept about 8,000. It paid 200,000 of it straight to the block builder as a tip to be allowed to go first. That's the priority gas auction right there, in one transaction. The bot did the work, and the auctioneer took the money. Now, this is where most videos throw a terrifying total at you. I'm not going to, because when I went looking, the scary aggregate numbers fell apart in my hands. Here's what holds up. Flashbots measured about 526,000 Ether extracted on Ethereum between September 2022 and June 2024. Call it $1.1 billion. But then ESMA does something almost nobody does. They put it next to the trading volume. And against what actually moved across Ethereum's exchanges in that window, it's roughly 0.12%. So is it a tax? Yes. Is it half your money? No. You deserve both of those in the same breath. And the regulator goes further. They look at the other big MEV numbers, EigenPhi, Sorella Labs, and essentially say, we can't check these. Little information is available on the methodology. So those are the numbers I'm not reading to you. Now you know why. One more thing that belongs here, because MEV stopped being an abstraction and went to court. Two brothers, MIT educated, were charged over a $25 million exploit of the block building system. It went to trial. And in November 2025, the jury deadlocked. Mistrial. The defense then asked the judge to throw it out entirely, and their argument is the interesting part, that Ethereum's own rules permit this, so it isn't theft, it's the game. The judge declined to dismiss, and as of today, it's still unresolved. Nobody has told us yet whether this is a crime or a strategy. And one genuinely good thing nobody reports, the regulator's own sandwich chart is titled, and I'm not paraphrasing, Downward Trend for Sandwiching. It's getting better. So now, Hedera. And I'll be straight with you, because it'd be easy to make this snarky, and it'd also be wrong. Hedera's answer to MEV isn't a patch. It isn't a plugin. It's the shape of the thing. Their argument, and they published a fresh version of it just this June, is that they didn't reduce MEV. They removed the conditions it needs to exist. And there are four. The first is the one in the title, and it's my favorite because it's so blunt. There's no public mempool. There's no waiting room. Your transaction doesn't stand behind glass while bots read it. It goes straight to consensus. And you can't snipe what you can't see. The second is that there's no leader. On most chains, one validator gets handed the block and decides what order things happen in. And that, right there, is where MEV lives. Hedera doesn't have that job at all. And don't take Hedera's word for why that matters. 2020, a team of cryptographers, Kelkar, Zhang, Goldfeder, and Jules, published a paper at Crypto, which is about as serious as that field gets. Their line? In leader-based protocols, which they note is almost every protocol used today, malicious leaders can directly choose the final transaction ordering. That's not Hedera marketing. That's the Academy saying the leader is the problem. And it's the same crowd. Goldfeder and Jules were on Flash Boys 2.0 as well. The people who named the disease went and wrote about the cure. Third, every transaction gets a timestamp that's the median of when each node says it first saw it. And a median is stubborn. You can't drag it around by yourself. So the order comes from a number, not a negotiation. And fourth, fees are priced in dollars and there's no bidding. Now, to be precise, because precision is the whole point of this video, Hedera does have a congestion multiplier that lifts fees network-wide when the thing gets busy. But that's a throttle for everybody. It is not you outbidding me for a better spot in the queue. And that kills the priority gas auction, because you can't outbid your way to the front when the front costs everyone the same. So credit where it's genuinely due. That's a real design position, taken years before it was fashionable. So, Joshua's word was immune, and Hedera has answered this twice, 3 years apart. And the answer got louder, In 2023, they asked, does MEV exist on Hedera? And at the hard part, what if a node actually tried it? Their words were that several factors make it challenging to extract any value. Challenging. And their reasons are honest ones. The odds are low. You'd get caught and lose your stake. It costs a lot. There's no mining reward pushing you to try. But look closely. Every one of those is an economic argument. That's incentives. That is not math. Then this June, the newer post says the record demonstrates manipulation was architecturally impossible, and that it's not a policy commitment. It's a mathematical property of the algorithm. So in 3 years, challenging became impossible. So I stopped reading the blog and I opened the developer documentation. And the docs, written for engineers who actually have to build on this, never escalated at all. They say a consensus timestamp is fair because it's not possible for a malicious node to corrupt it and make it differ. By very much. By very much. Further down, even if a few nodes maliciously give times that are far off, the timestamp is not significantly impacted. And on ordering, there's no way for an individual to unduly affect it. Unduly. Now this isn't a gotcha. Not by very much is not the same sentence as cannot. Not significantly impacted is not the same as unaffected. Those are hedges, and they're the right ones, the honest ones. What I'm telling you is that Hedera's engineers are more careful than Hedera's marketing department, and that is a compliment to the engineers. But the docs go further than that, and this is the sentence that actually answers the question. They say the timestamp will be honest because it is generated by an honest member, or it falls between two times that were generated by honest and reliable members. Falls between. That's a range, not a point. So the timestamp isn't pinned to one true value. It's fenced inside a window. And that changes the verdict from impossible to bounded. Here's what that means in plain English. No single node can pick the winner. That part is completely true, and it's the part that kills sandwich bots. But a coalition, working together, approaching Hedera's own 1/3 ceiling, can nudge where inside that honest window a transaction lands by choosing when to pass it on. They can't invent a time. They can't drag it outside what honest nodes actually saw. They can lean on a photo finish. So the median is a real mathematical property. It's just that the property it guarantees is boundedness, not immunity. Architecturally bounded, not architecturally impossible. And honestly, bounded is still a really good place to be. Almost nothing else in this industry can even claim it. And while we're being precise, the assumption, the docs say if more than 2/3 of participating members are honest and have reliable clocks on their computer, then the timestamp is honest. 2/3 honest and working clocks. Nobody ever mentions the clocks. And when you dig, that 2/3 isn't counted in nodes. It's counted in stake. It's a stake-weighted median. So it's really, so long as attackers hold less than 1/3 of staked HBAR, they can't skew the timestamps. And who's holding it? In Hedera's own words, the consensus nodes are chosen by the governing council. It's a permission set, around 30 organizations, and permissionless node operation is still not live. That's not me accusing anyone. That's their own roadmap. It's a genuine trade-off, and they own it. And here's what made me sit back. Remember ESMA? Their explanation for why MEV exists at all is that it is virtually impossible in a decentralized system to ensure a precise enough and non-manipulable timestamp. That's the regulator saying the thing cannot be done. And Hedera says, we did it, with a median. And they're both sort of right, which is the most annoying possible outcome. There's also a scope thing. Both posts only ever cover ordering at the consensus layer. And 5 days ago, we got a very expensive reminder of why that distinction matters. On July 11th, Bonzo, the biggest lending protocol on Hedera, lost about $9 million. Someone deposited a few dollars of a token, pushed a fake price through a third-party oracle that accepted a signature it should have rejected and borrowed against it. Bonzo's locked value fell 77%. Hedera's overall fell about 40 in a day. Now, that was not MEV. It wasn't ordering. Hedera's consensus did its job perfectly, and Bonzo's own contracts weren't broken either. It was a bug in somebody else's oracle, and it's been patched. But that's exactly the point I want you to take. Fair ordering is a real shield, and it is a specific shield. No public mempool doesn't mean no DeFi risk. It means no mempool. Those are different sentences, and last Saturday is what the difference costs. And then the documentation handed me the real answer to Joshua's question. They describe Alice and Bob both trying to buy the last share. No individual can shove Alice ahead of Bob. And then they say this: the best Alice can do is invest in a better internet connection, so her transaction reaches everyone first. And they call that the fair way to compete. Read that again. The advantage didn't disappear. It changed shape. Hedera took away the fee auction and took away the glass room, and what's left standing is whoever is fastest. Fair ordering closes the bribery door. It doesn't close the speed racing door, which, if you remember the original Flash Boys, the Michael Lewis one, about fiber lines and microwave towers, is exactly where all of this started. Crypto took Wall Street's speed race and turned it into a bidding war. Hedera turned the bidding war back into a speed race, and it says, straight-faced, and I think correctly, that of the two, the speed race is the fairer one. So that's part one, and I owe Joshua part two. If Hedera really did this, why isn't it showing up in the token? I'll give you the least satisfying answer in crypto, and then why it's the most useful one. MEV resistance is an engineering property. Token prices run on cycles, on liquidity, and on story. Those are two different machines. Expecting fair ordering to move a chart is like expecting a car to be worth more because the engine has fewer moving parts. It might genuinely be better built. That's just not the thing being priced on a given Tuesday. That's not a contradiction. It's a category error. Which is why I'm not going to tell you what any of this means for the price. Not today, not ever on this channel. I'll tell you how the thing works. You're an adult. But here's where the engineering does show up. Not on a chart, on a calendar. July 2025. Aberdeen Investments, Lloyds Banking Group, and Arcax did something never done before in the UK. They took tokenized units of a money market fund and tokenized UK government bonds and used them as live collateral for a real foreign exchange trade under FCA oversight. And those tokens were issued and settled on Hedera. And just yesterday, the UK Treasury's own report on wholesale digital markets cited that exact trade as a benchmark. So why would an institution care about fair ordering? Under European rules, under MiFID II, a firm has to demonstrate a client's order got the best available terms. So if your order can be seen sitting in a public waiting room and front run before it executes, and the price moves against you, you cannot demonstrate that. The architecture and the regulation are simply incompatible. That's not a vibe. That's a compliance officer saying no. And that's the actual market for fair ordering, not traders, auditors. So here's the reframe, and it's the one I gave Joshua. Judge the architecture, not the candles. The architecture is the thing you can verify. It's written down, it's testable, and it'll still be true next quarter no matter what the chart did. And if you want the honest picture of HBAR supply and where staking rewards actually come from, I did a full tokenomics deep dive on exactly that. It isn't flattering in places. It's on the channel, and it's the right video for that question. This one was about whether the machine does what it says. So, 2 things to walk away with. The first is free. All of this is checkable. That ESMA report is a public PDF, a regulator, 17 pages, real charts, and they print their own limitations right there on the page. There's a box in it called measured versus actual MEV, and it might be the most honest graphic in this whole subject, because it shows that what we can measure is the small circle in the middle, and the real thing is bigger, and we can't see the edges. Go read it. It costs nothing, and it's better than most crypto research you'll pay for. The second thing is the durable one. It's a habit. When a chain claims immunity to something, go find the word the chain's own engineers use. Not the blog, not the landing page, the documentation. Because Hedera's marketing says architecturally impossible, and Hedera's docs say falls between two honest times. Same company wrote both sentences. Only one of them was written by somebody who'd have to defend it in a code review. So, the honest verdict. Hedera didn't build a wall around MEV. They built a room with no glass, no queue, and no auctioneer. And the ways bots eat retail on other chains mostly have nowhere to stand here. That is real. It's rare. Almost nobody else did it, and they did it years before anyone was asking. But immune is a bigger word than Hedera's own engineers will sign. The right word is bounded. And the advantage didn't vanish. It went back to being about speed, which, if you've read Flash Boys, is a story we've already seen. And at least this time, the fast guy has to actually be fast. So look, this video exists because Joshua asked a genuinely great question in the comments and didn't let me off the hook with a one-line answer. Joshua, this is the answer. Thank you, because I learned a lot building it. That's the deal here. You ask, I go read the documentation, and we find out together. So if there's a chain making a claim you can't quite swallow, put it in the comments. That's exactly where this one came from. If this was useful, a like really does help. And subscribe if you want more of the read the docs, not the blog kind of thing. There's a full written version with every source linked in the description. Go check every number I said out loud. Please do. Thanks for watching, and I'll see you in the next one.